Investors Chronicle.
Hello and a very warm welcome to Season 2 of Lee and the IC. I'm Alex Newman, an Associate Editor at the Investors Chronicle, back in the FT studios after a 3-month break, and very pleased to once again be in the company of a man recently described as the David Attenborough of investing, Lord John Lee of Trafford. John, how are you doing today?
Fine, thank you. Beautiful day outside.
Yeah.
So hopefully this won't last too long.
Good stuff. Today we'll be dedicating this show to the latest additions to John's portfolio. There's lots to catch up on besides. Since we've last spoke on here, we've had a change of government, and bar a mini equity market crash about a month ago, a steady uptick in domestic shares. I should, before we press on, start with the same old reminder that everything we talk about on this podcast is for educational and entertainment purposes only, and none of it should be taken as financial advice or recommendation to buy or sell shares. And as always, we would urge you to do your own research. John, last time we were here in the studio, we were speaking with Louis Hall of Cerillion, what I think is one of your strongest performing holdings and a company whose share price has marched ever higher since we spoke with Louis, despite a pretty punchy rating. That didn't leave a huge amount of time to discuss your portfolio when we last met, which, as you'd alluded to in a previous episode, was suddenly quite flush with cash after the takeover of Lok'nStore. Can you briefly remind listeners of that deal and maybe start with any existing holdings you might have topped up with the proceeds?
Yes, well, Lok'nStore was a great success. It was a business I invested in some years ago. Sadly, most of my holding was not in my ISA, but nevertheless, one was very pleased to see it grow over the years. It's a holding I built up, as is my normal approach. When I like something, I tend to build up on it, so it became a significant holding. And I always thought that at some stage, the key driving force, Andrew Jacobs, who had 20-odd% of it and had built it up, would probably want to exit and do a deal. And sure enough, that happened. And I think he's probably got his timing really spot on through a combination. I think the self-storage market has softened a little, and also likely increases in taxation, as it were. So he probably wanted to do a deal earlier. And from my point of view, this obviously produced a substantial amount of cash. I actually got a slightly higher price than the bid price. Because there was then an expectation in the price that maybe there might be a counter bid, and I thought that unlikely
because I think he'd given his kind of irrevocable undertakings,
and I think also there are a fairly small number of significant companies in the sector, and they would all know each other, as it were. So I think he would have had a pretty good idea as to whether there was a better offer around. So for me, that produced quite a significant amount of liquidity, mostly outside the ISA, some in the ISA. So there will be, even on present capital gains tax rates, a significant liability which I have to bear in mind and keep some cash back for. But it did give me the opportunity, obviously, to top up existing holdings where I had confidence, and also to look at one or two new positions as well. So the majority of the money has been spent, but not all of it.
So just to go through a couple of those pre-existing holdings, PZ Cousins, we've talked about a couple of times here, was one of them, ditto VP. And then also your kind of income favourites, Legal & General and M&G, got another top up there.
Yes.
Yeah.
I think the largest slug of money went into topping up my M&G holding, which is my largest holding now. I think the combination of a near certain 9% dividend yield, plus the prospects of capital appreciation, too good an opportunity to miss. So I built that holding up M&G significantly. And I also added to Legal & General as well, which hasn't performed particularly well, but once again does deliver a very substantial dividend yield. And of course, both of those are in my ISA. So those yields are tax-free and therefore attractive and balance some of the small cap stocks that I've got where the dividend yield is not so great. So overall, the mix is useful.
Yeah, and I think a theme we've talked about in the past, that kind of having a recycling effect within your portfolio to then give you the firepower for new ideas as they
That's
come
right.
up.
That is absolutely right. I mean, my portfolio and my ISA over the years, over a long period, have been built up. Really, I would say, to use a phrase, brick by brick. So I've been on the receiving end, I think, as I mentioned before, of probably over 60 takeovers. And while looking back, I wish some of those companies had remained independent and continued to grow and increase dividends and capital appreciation. Nevertheless, receiving those premiums on takeover and giving one the liquidity to reinvest and top up and find one or two new holdings obviously has been a crucial part of my whole approach.
Yeah. Brick by brick, buy and hold, slow and steady, I suppose the maxims might be. But I just wanted to touch on a couple of instances of where you've had to navigate takeovers, or you've chosen to navigate takeovers in the last couple of months. You touched on Lok'nStore and your decision to sell out a little bit of a premium to what was the agreed price there. With the proceeds, I mean, one of the things you told me a few weeks ago, you took a bit of a punt on another offer being increased. It's quite interesting. You're having a bit of a kind of moving in and out of some ideas.
I think as listeners will know, I'm very much a long-term investor. A buy and build up and hold man, and patience, of course, to me is probably the number one, and that's what most investors find difficult. But very occasionally, obviously, I'm tempted in a short-term trade with a small amount of money, rather not serious money, as it were. Years ago in the past, I tried this technique of going in after a bid had been announced in the hope that there would be a counter bid or an improved offer, and it didn't work years ago. And I realized that the principal reason it didn't work out years ago was that actually I was trying to do it in a bear market, in a falling market.
Okay.
And to do it successfully, I think you need to do it in a market that is steady, or better still, an appreciating market, which is broadly what we've had over the last 2 or 3 months. So I think you do need that background. And then, of course, you do have to be very selective. I think it's rather like professional punters on horses, as it were. The serious professionals don't back on every race. They wait until there is an opportunity. And so I'm not suggesting that one should rush in when any takeover is announced. But I was particularly attracted by the Britvic takeover offer from Carlsberg, which was fairly standardly rejected by the Britvic board as undervaluing the business, and the usual phrase. But from my experience, a major global buyer or potential buyer company like Carlsberg, running the business, taking a 20, 30, 40-year view, as it were, will have done a huge amount of due diligence on Britvic and decided, rightly or wrongly, that Britvic products would fit in to their Carlsberg's existing portfolio, or could be built up, as it were, and this was an area that they wanted to go for. And therefore, the combination of that and the relative sizes of the two, Britvic being obviously significantly smaller than Carlsberg, caused me to take the view, and you can never be sure in this sort of situation, that Carlsberg, and pride comes into it as well. The large global companies, chief executives, that they don't want to be seen to spend money on a takeover and raise expectations and then just walk away. It's not terribly impressive. So my view was that there was every likelihood of Carlsberg coming back with an increased offer, which hopefully would be agreed, and that is what happened. So I made a small turn on it.
Yeah.
Nice to have a little profit. Nice to be proved right, as it were, but you've got to be very selective, and that's not really part of my serious investing.
Yeah, it was interesting though. I suppose the big M&A story, which didn't really happen this year, or the bid collapsed, was the BHP Anglo one.
Sure.
And it was very interesting to see after the initial bid that the market bid up.
Yes.
Immediately on a similar expectation that they would raise the bid, but that didn't continue or ran out of steam.
Sure.
So it doesn't work in every instance.
It doesn't work in every case. You have to be very selective. And you need a little bit of luck as well,
Yeah.
obviously.
So you've got not one but two new holdings in the portfolio, both of which I think have decent value credentials, potentially a bit of a kind of turnaround story there. Talk to me first about ITV.
Yes, well, ITV is obviously a company that one has known over the years, as it were, and has had quite a battering. And of course, commercial television has had a difficult period with the pressures on advertising and advertisers. But that appears to be coming back now. And also the content creation of companies like ITV and STV, which I hold, are of increasing value and importance, and of course are I say exported, for want of a word, globally, sold globally on some sort of basis. And it seemed to me that ITV had reached a level. They recovered from the bottom, but at a level where there's a 6% plus dividend yield, which looked to me pretty sustainable, and fairly optimistic comments from the company. Advertising coming back seemed to me to make a good story for a modest investment, and it's a modest holding. It's a toe into it, as it were. I would have thought there's every chance of some sort of corporate action at some stage. But it's not one at the moment that is a significant holding, but it is a new holding.
Yeah. What was the catalyst which drew you to ITV then? I saw they had results which seemed to be turning the corner about a month ago.
I think the results turning the corner, a little bit of corporate optimism. I also, to an extent, know the chairman as well. I was at school with him, but I've not talked to him about the company. But, he's had a fairly successful commercial track record. And there was also quite a bit of media comment on ITV. Pretty well all the investment commentators' conclusions were that ITV was undervalued and the price was too low. So the combination of my own intelligence and the media comment caused me to think, well, we'll make an initial investment here.
Yeah. The second purchase has been Braemar, formerly known as Braemar Shipping, might be better known to some listeners. This is a case of a company you've invested in before, I think I'm right in saying.
Yes, years ago I invested in, I can't remember why, but a long time ago. In recent years, Braemar's had all sorts of corporate problems, but does seem to me now to have sorted itself out. I went along to the AGM recently, talked to board members and talked to the chief executive and was shown the operation there, their offices just off Trafalgar Square. And of course, it's a sector where I have done very well in the past, shipbroking. And there are only two quoted shipbroking businesses, although some of the activities are wider than that. Clarkson, of course, is the big daddy of the sector, and I did very well on Clarkson's buying years ago, just after I think they had divested of their package tour business. So going back a long time, and I remember buying them on a 10% yield when they were stuffed with cash, and I thought it was a great opportunity. Sadly, I made money on it, but I didn't stay long enough. I took my profit a few years on and moved on. But it has been a great success story, a great growth stock, and I'm glad to say that I bought some shares for my two young daughters then, and they have kept them ever since, and so they've done very well. So global shipping, broad brush, is a growth industry. People don't realise this, but shipping overall is growth. And at the present time, rates in certain sectors have been quite high. Obviously, charters have been lengthening with the problems in the Middle East and the Houthis and similar. There is a shortage of capacity, so plenty of orders for shipbuilding, and here again, Clarksons and Braemar are involved in placing orders for new vessels, new container ships, and similar. Whereas, understandably, Clarksons is very highly rated. Braemar, because of its past difficulties, is far less well known and much lower rated. I think the prospective price earnings ratio on Braemar is single figures.
Yeah, I think it's around 8 or 9,
something like that. And there's a nice 4.5% yield, which is significantly greater than Clarkson's. And I think now they've cleared the decks, as it were, of their troubles. Certainly, there was a fair amount of optimism at the AGM and the board expressed the view that they thought the shares were considerably undervalued. Not that that's original, because virtually every chief executive and similar of small cap stocks think their own shares are undervalued. But I think they're entitled to take that view in the case of Braemar. So I think it's an attractive service industry to invest in on a very modest rating. And, I see it growing. The chief executive is ex-Clarkson's himself, James Gundy. He's built up quite a significant personal holding, and relatively recently added to it, which is always a useful signal for me. It's quite a nice and growing medium-sized holding for me. Not really moved since I bought it, but patience is one of my attributes.
Yeah.
I hope. I think.
So Clarkson, just to sort of chime in there, I think is looking at to be on about a kind of 15 times forward earnings multiple, which is not by any means an outlier based on their recent history, but yeah, I think close to double almost where Braemar is. It's tempting to see this is a sector where a rising tide can lift all boats at the same time, but there's also there are also client relationships. There's an element of prestige in shipbroking, as there is in other services businesses. And there's of course, execution, which Braemar has lacked or wanted for in recent years. Again, were there any sort of catalysts you got from the AGM, aside from tone, where they think they can either close the gap or where they can, perhaps emulate some of the things that Clarksons have done, given that their CEO was,
I think yes, there was certainly quite optimism about the business itself. But then also, I think an acknowledgement that they were hardly known as a PLC, and that really they had a profile lifting job to do. And I think I'm right in saying they've just changed very recently, broker, no doubt, in the hope expectation that new institutional investors will come on board. At the moment, I don't think there are any institutional investors of particular significance. So I'm not sure whether Schroders may not have a.
They're not huge, are they? I think it's 100
million. It's just short of 100 million, whereas I think Clarkson's is about 1.2 billion, something like that. And of course, there are some substantial competitors, private companies around the world. So, there's every possibility that one of those private companies may well take a shine to a modestly valued. And obviously, there's also the potential for, particularly if Braemar does stay undervalued for a long period, for private equity to alight on it and come along and believe that they can do rather better.
Your mention of the chief executive's share purchases there brings us neatly, I suppose, to another area of focus for you of late, which is boardroom shareholdings, I suppose, with a particular focus on non-executive director holdings or a lack thereof. I understand that's a point you raised not only at Braemar's AGM, but in a recent panel with Secure Trust Bank we've talked about in the past. And I mean, last time you said that you think companies should be requiring NEDs to take at least 25% of their income in shares, or building a similar stake within a couple of years. How's the campaign going behind the scenes?
Well, the answer is the campaign's hardly taken off, really. But what is encouraging to me is that virtually everyone I mentioned the thought to has supported me, apart from some of those non-execs themselves, who seem to think it's quite acceptable to collect between sort of 50 and 100,000 a year from a company and not buy any shares in that business, which is something I find totally unacceptable. I mean, sometimes I don't know who those non-execs think they're representing. I mean, they're not there to represent, Just Stop Oil or Friends of the Ocean or War on Want, as it were. They're actually there as representatives and appointed by we shareholders to hopefully grow the business and increase value. I think that they have maybe not a legal obligation, but I think a moral obligation to put back a proportion of their director's fee in the shares of the company where they're on the board and quite generously paid. At the moment, there are so many of the small caps where non-execs have next to no shares, in many cases no shares at all. Clear implication rightly or wrongly, that they believe their savings are better invested elsewhere. Now, that's not, from my point of view, not over-satisfactory. If they don't believe there is growth and potential in the business where they're on the board, then they should actually be, either do something. They should be doing something about it in terms of maybe, prodding the chief executive or changing the chief executive. But I think there's an obligation to put back some of that fee into shares, and I would suggest that say by year 2, a non-exec should invest at least 25%, if not more, of their annual fee. I mean, this is sort of broad brush in the shares of that particular company, and I think institutions and private shareholders should increasingly, in my judgment, press non-execs who don't have any holding to buy shares and query, if they don't buy shares, why they're not buying shares.
The risk of points well taken. I think perhaps to play devil's advocate here, I know you look at director deals as a useful signal when your share purchase.
Very useful.
Yeah.
I mean, I mentioned a little bit earlier talking about Braemar.
Yeah.
The fact that James Gunn, the chief executive, had been adding to his holding, but more recently, for example, or quite recently, in the case of Secure Trust, where I'm invested, the banking business. David Macready and his wife, chief executive, and his wife, they bought over £100,000 worth of shares, which is significant and a good indicator of his confidence in the business, and the shares are good value. And also, I was intrigued that in VP, the plant hire firm based in Harrogate, where I am a holder, the husband of the company secretary invested £250,000 in VP shares. So these are good indicators. And going right back to the start of our conversation today, the fact that Andrew Jacobs had 20-odd% of Lok'nStore, to me, real skin in the game, to me was a great plus, because I knew that obviously most of his wealth was there, and that he would obviously protect it, as it were, and perhaps exit at the right time.
But given that it helps you make decisions, then do you think there's a risk that by almost mandating purchases, it can add noise to those signals for investors? In other words, do you think that by setting it as almost the price of entry to the board for an NED, it's confusing because it doesn't necessarily tell us anything about their own insight or to the business? Or is it just the case that once you're invested, you treat your role in a different way? Is that the argument?
Well, I think the argument is, yes, they should at least have a holding in the business, as it were. But obviously, what I would regard as a really positive signal, if the non-executive actually bought significantly into the business, as it were, rather than what I may term a more token holding. And for example, in the case of Vianet, which is another holding of mine, the old Brewlines business, a relatively recent non-exec, Mrs. Paul, I think from memory, has made some quite significant purchases in the business, in a business where the chief executive, James Dixon, over the years has built up a significant holding. I think he's got about 18% now. And I like to see chief executives and the main driver of a business having 18, 20, 25, 30% of the business. And, that's one of the encouraging features of Cerillion, which we talked about a little earlier, where Louis Hall, the individual chief executive, was on one of our podcasts. And, he has got a significant holding in Cerillion, which, once again, I regard as good news. Skin in the game is pretty crucial as far as I'm concerned.
To wrap up, it's going to be remiss of me not to ask one of our parliamentarians for their thoughts on the new government. I mean, if there was a honeymoon period, opinion polls suggest it's well and truly over now, though I'm assuming you're glad that any threats to cull peers over the age of 18 seem to have been put on the back burner for now. The message from the Chancellor and PM is that, this is going to be a very pro-business government and pro-big I investor. Do you think this government appears to be pro-small I investor, the retail investor, or is this yet to be determined?
I'm not sure they're focused on the retail investor yet, to be quite honest. I think that Rachel Reeves has got a very difficult balancing act to perform. Even if you discount some of the exaggeration in Keir Starmer's recent speech about the size of the deficit they inherited, as it were. There's obviously a degree of exaggeration there. Nevertheless, it is certain that taxes are going to be increased. I've said on this, I'm sure, on our previous podcast, that I thought it was certain that capital gains would be increased. And I think probably inheritance tax as well in some form. I think the more tricky area for her will come in decisions, for example, on business property relief, where there are obviously inheritance tax reliefs in AIM stocks. If she withdraws that and hits that obviously is going to send a slightly negative message to those who she's asking to grow and develop businesses and invest. And she's obviously an intelligent woman, as it were. So I think that while it's certain that capital gains tax is going to go up, I don't think rates are going to go up. I hope I'm wrong. To penal levels. I remember going back, when with investment income surcharges and all sorts of things, you were paying about 98%. Well, if we ever went back to that, then that's would be a big turn-off, quite clearly. And you've got to encourage your entrepreneurs and your wealth creators. So it's going to be quite tricky for them. And I think there is a real worry that new government, Labour government, gave in to the striking unions rather too quickly. Not so much too quickly, but they don't seem to have got a great deal in return.
In terms of goodwill.
Not so much necessarily in terms of goodwill, but in terms of, alteration in working practices for the sake of argument. They don't seem to have got much in return. So you're clearly going to get now a situation where virtually all the unions are going to be queuing up, as it were, and expecting. And so I think the government is going to have quite a difficult hand to play there. And, we could have, inflationary pressures coming through. And obviously there's going to be costs that businesses will have to bear, or the taxpayer will have to bear. Those of us like myself, to use the phrase, of broad shoulders, are obviously watching carefully, some with more trepidation than others, as to what's going to be announced at the end of October in the budget.
Well, I suppose one of the areas you did just touch on it there, perhaps of greatest trepidation for some investors, is the capital gains tax question. You've said you expect it to rise already. I don't know if that we should infer from that you've made a degree of peace with that reality. The question for some investors now, vis-a-vis, do I sell now? Do I bed and breakfast where you sell and then buy back your shares for kind of tax planning, all these sort of considerations? Do things like capital gains rates factor into your decision-making outside of your ISA around the timing of sales?
A little, and I'm very conscious outside my ISA of 3 or 4 holdings where they're significantly pregnant with profit, and therefore, do I sell and trigger a certain capital gain, or do I hold off, knowing that at some stage in the future I'm going to maybe be on the receiving end of a takeover bid, as it were, and end up paying a larger rate of capital gain. So in 1 or 2 cases I have done some trimming. But of course what all this does point to is the great plus of the ISA, which has been a very significant part of my overall investment life, and of course is probably the best tax-free wrapper in the Western world. Now, I don't think there's any real risk. I can't believe that existing ISAs will be touched because, they were sold quite clearly, as tax-free wrappers. And I think it would be a gross betrayal if government tried anything retrospectively. What they may well do is to say, if your ISA is worth X, you can't add anything to it, as it were, from the outside. Or, I think this is more likely, or they may well limit the amount that people can put into ISAs. And I have to say that at the moment, I think to allow a husband and a wife to each put £20,000 in is probably somewhat excessive. And I haven't been adding to my ISA significantly in recent years. I benefited from the internal growth of it and the reinvestment of dividends and takeover proceeds. But I think, given the new climate we're in, I think to allow, by definition, wealthy people to protect £40,000 a year, husband and wife, in tax-free form, is probably not ideal, not acceptable, really. And I wouldn't be at all surprised if that wasn't trimmed in some form.
The obvious trade-off, I suppose, being those, I suppose, those slightly below the ultra-high net worth tiers who are either trying to catch up with pension contributions late in the day, who might fall into that bracket.
I'm sure there will be inevitably there'll be some who will fall into that bracket. After all, I think it's only the very wealthy or the very comfortably off who are in a position to put £40,000 a year, husband and wife, into an ISA, as it were. So I'm not sure I would shed too many tears if that happened. I mean, over the years, of course, the amount you could put in a PEP, the precursor to an ISA or an ISA, has changed. I remember, I think it was 87 when PEPs were introduced. You could put £3,000 in. That was the original figure that I started putting in, and then it gradually built up and has been altered over the years.
I'm sure we'll return to these topics in greater detail later on in the series, after the budget, after who knows what is coming down the line, and once we know a little bit more about the new administration's plans. Next month, we'll be speaking with the chief executive of another of the smaller companies John holds, though no spoilers as to who that is yet. But until then, if you have any questions you'd like to put to John, you can do so by emailing me at alex.newman@ft.com. All that's left for me to say is to thank you for listening, to John, as ever, for your thoughts.
Thank you.
And to our producer, Maddie Apthorpe. So until next time, goodbye.